Let's have a look at this example. It says that company Jupiter Limited has two classes of shares in issue. 1 lakh ordinary equity shares and 50,000 non-convertible preference shares. A fixed dividend of 10 rupees per share is payable to the preference shareholders before any dividends are paid to the paid on the ordinary equity shares. Ordinary equity dividends are then paid, in which preference shares, do not participate. The preference shareholders also participate in any additional dividend over and above ordinary equity dividend of ₹4 at a rate of 50% of any additional dividend payable. Okay, and then Jupiter's profit is 10 lakh rupees and dividend of 4 rupees is declared on ordinary equity shares. You are required to compute allocation of earnings for the purposes of calculation of basic EPS when an entity has ordinary shares and participating equity instruments that are not convertible into ordinary shares, and then the EPS. Now, there's a bit of an information available. The important point that you want to pick up is there are 1 lakh equity shares and 50,000 preference shares. Okay, there is a 10 rupee dividend which is paid to the preference shareholders, and then there's a 4 rupees of dividend which is paid on the equity shares. Okay, now essentially anything over and above, any additional dividend that you're paying, okay, to the ordinary shareholders, 50% of that dividend is also paid to the preference shareholders, right? So given the profit of 10 lakh rupees, you need to distribute that 10 lakh between how much is something which is allocable to the preference shareholders and how much of that is, of course, available with ordinary shareholders, because whatever is available with the ordinary shareholders shall be used for the calculation of the earnings per share. Okay, that's something which is the crux that you want to pick up. So the way we want to kind of proceed here is that we are given profit after tax, which is 10 lakh rupees. Okay, so let's pull out the preference dividend, and that is provided that you're paying 10 rupees for these 50,000 shares, right? 10 rupees on each share. So this 5 lakh is also taken out of the equation, and then you're left with the balance of 5 lakh rupees, out of which you're paying an equity dividend. You would recollect 4 rupees on 1 lakh shares, 4 rupees on each of those 1 lakh shares, which means even 4 lakh is gone. What you are left with now is, of course, 1 lakh. Okay, now we are provided that if you are giving any additional dividend to these shareholders over that 4 rupees, which you have already given, by the way, okay, the preference shareholders will receive 50% of that dividend which is paid to the shareholders, with the equity shareholders specifically, right? So essentially, we are saying that this 1 lakh will be divided between the equity shareholders and the preference shareholders. Okay, say for the sake of argument, we are paying an X rupee, let's say, to the equity shareholders on each of the shares that they own. So effectively, this is what they will get, 1 lakh of X, right? It has to be, of course, not in rupees, it has to be in paisa. Okay, but then the preference shareholders who are owning 50,000 shares will get 50% of that X. Okay, so if you understand this equation, we are very comfortable, and we are very much settled with the requirement of the case. Essentially, we are saying that 1 lakh of X, let's say, use this as X parameter because this multiple is also X, right? So 1 lakh of X plus 50,000 into 50% into X is basically 1 lakh. Now, this is the amount, of course, which is this figure, right? So when I solve this equation, that becomes 1 lakh x and 25,000 x, which is of course equal to 1 lakh. So that would be 1 lakh 25,000 x is equal to 1 lakh. That gives x as 1 lakh divided by 1 lakh 25,000, and that becomes 0.80. Okay, so what I was saying here is that the equity shareholders are receiving 80 paisa or 80% on 1 lakh, right? And the preference shareholders are receiving the balance 20%, right? On that 50,000. Okay, so that's how you start looking at the segregation or the division of the profits, right? And then eventually we are saying the total dividend to the equity shareholders is 4 rupees, which is this amount, plus 80 paisa, which makes it, of course, 4.80, which is the EPS in this particular case. Okay, so you start reading the requirement of the question, look at that information, and you're able to obviously find that requirement done as well. Okay, let's have a look at the formal solution on this. We're given that the calculation of basic EPS, 10 lakh was your total profit. You pay 5 lakh rupees to the preference shareholders. You pay 4 lakh rupees to the ordinary shareholders at rupees 4, of course. You're left with that amount of 1 lakh rupees, which is not distributed so far. And then you divide that, you allocate this so-called as, the earnings, between how much is applicable to ordinary shareholders and how much is to the preference shareholders. We received this calculation of 80 paisa. Of course, it was 20,000 rupees for, the preference shareholders, but since there are only 50,000 shares, so that calculation becomes 40 paisa a share. And when you look at, of course, the eventual calculation of the earnings per share, this is something that you calculate, which is 4.80. Of course, the preference shares EPS is also calculated, which is not exactly the need in this particular case. Okay, a very straightforward question, right? But then look at the requirements carefully and just establish that understanding that when you look at the EPS, it is not necessarily driven by, the dividend paid, right? Dividend is just a recovery of or realization of that, profit. What is important is how much profit is actually available for the ordinary shareholders. That is where the EPS comes in the picture. Okay. Now, one concept that you want to also remember, that when there is an early conversion of convertible preference shares, right, wherein probably the holders believe, or the preference shareholders think, that they would get a premium because the value of, that preference share is different from what it originally was, or if there's a additional amount paid. So even that amount is factored in calculation of earnings available with the shareholders, right? So we are saying that the excess of the fair value or the consideration paid over the fair value of ordinary share issuable under original conversion term, right, is essentially a return to the preference shareholders, and that is also adjusted, factored in, right, while calculating the profit or loss as available to the ordinary shareholders for EPS purposes. Okay, that's something that you want to also remember as a concept. Okay. Partly paid shares. Now, importantly, what we had been talking so far is that profit is a function of money, right? But what if you don't receive the full money, right? What if the shares are not fully paid? How do you deal with that, right? The concept suggests, and logically so, that any partly paid shares are treated as a fraction of an ordinary share. Okay. To the extent they are entitled to participate in the dividend as related to a fully paid ordinary share. Okay. So from that context, you start looking at the the adjustment to be made to the number of shares, essentially to arrive at, let's say, the EPS, right? An easy example, I'll come to the second paragraph in a minute, right? An easy example is that there is a company X, let's say, versus a company Y. Okay. So let's say the profit is 10,000 here, let's say 20,000 here, could be any random numbers. Okay. Let's say the number of shares are 50,000. And let's say in this case, this is again, let's say 40,000, right? Now we are saying that this is having a face value of rupees 10 and amount paid is also rupees 10. Okay. But in this case, the face value, which is 10, and the amount paid is, let's say, rupees 5. Okay. What are we trying to bring here is that if the amount paid is rupees 5 and the number of shares are 40,000, right, against the face value of 10, effectively you have only issued half of the shares, right? From the context of the money received, you only issued half of those shares. So for the calculation of EPS, your equivalent number of shares should be 20,000. Is it okay? I mean, the whole idea is that how much money you would have received had you, for example, received the entire value of the share. That would have been 4 lakh rupees, right? So when you're only receiving, or when the shares are partly paid, you have only received 2 lakh versus 4 lakh. So against this 2 lakh, what is the equivalent number of fully paid shares? It is 20,000 only, right? And that is what you want to kind of consider in this particular calculation. Okay. So all we are trying to say is that you look at the equivalent number of shares, which is 20,000, and when you calculate the EPS now, this would be, of course, 0.20 versus 1.00. Okay. So that's how you start looking at the relevance of whatever it's a partly paid share. Okay. So we're going to go back to the concept. We are saying that to the extent that the partly paid shares are not entitled to participate in dividend, they are treated as equivalent of warrant or options in the calculation of diluted EPS. Now, we have not discussed as yet what is the meaning of diluted EPS, right? So we'll not be talking about it here. So these two paragraphs is something that we want to discuss a little more detailed when we have discussed the concept of, let's say, dilution, right? But then you just want to kind of remember that, because we talk about the reference of a partly paid share in the context of the basic EPS, right? And that's what you want to remember. If the shares are not fully paid, they are treated as a fraction of an ordinary share. Okay. Now we have an example to, let's say, pick up on this part where you start looking at the details of this. It says that Pluto Limited has issued 2 lakh ordinary shares of rupees 2 each for a consideration of rupees 5 per share. Okay. 3.5 rupees were received by Pluto till the balance sheet date. The partly paid shares are entitled to participate in dividends for the year in proportion to the amount paid against each share. Question is, you're required to calculate the number of shares for the EPS under the Ind AS 33's perspective. Now the question is, there are 2 lakh shares. Face value is 2 rupee. The fair value is 5 rupees. So basically what we have is 2 plus 3, which is basically the face value, plus of course the premium amount. So that becomes 5 rupees, right? But then so far you have received 3.5 rupees on each share. Okay. So it becomes, of course, a partly paid share. So effectively, we are saying that for the 2 lakh shares, right, what is the proportionate amount that you have received, right? We are saying for 2 lakh shares, the equivalent number of shares for the purposes would be 2 lakh into 3.5, which is the amount received over the total value that you would have otherwise received is 5 rupees. So that becomes, of course, 1.4 lakh shares. Okay. Essentially, what I was saying is the money that you received is basically 7 lakh rupees, right? But at a fair value of 5 rupees, what are the equivalent number of shares? Which is 1.4 lakh. And that is how you calculate the number of shares equivalent for the calculation of basic EPS. Why are we doing it? Profit is a function of money, right? If you're receiving lesser money on the number of shares issued, accordingly, your profit would have also reduced. So your number of shares should reflect that differential amount. Okay, that's what we have got. This is the answer. The partly paid shares are treated as a fraction of ordinary shares to the extent that these were entitled to participate in dividend during the period relative to a fully paid ordinary share. You don't expect, if it's a partly paid share, you don't expect to receive a full dividend on that. That would also be partial or a pro rata. Okay, and that is where the ordinary share equivalent would be taken on this particular basis. Is it comfortable? Right. Now, this is the next section that we want to talk about, which is about the bonus or stock split. Okay. Before we get into that, let's start to understand what is a bonus issue to start with. Okay. A bonus issue is basically shares issued to the existing shareholders without any considerations. These are free shares, right? Why would a company issue that? Well, maybe they don't want to declare a dividend, so they might just want to, create a value. Although at least fundamentally there's no value in that, but they might want to kind of create a bigger value for the shareholders by issuing something in bonus. Of course, the value of the shares would decline in the same proportion. Okay, but the fact remains, if there is a bonus issue, are the number of shares increasing? The answer is yes, right? If it's a 1:1 issue, it simply means if I had 1 share, I will have 2 shares now. Okay, so the number of shares are increasing. But is the money received on those additional shares? The answer is no. Okay, so what is the consequence? Automatically, it would appear that the EPS is declining because the denominator is increasing, right? But since no money is received, and because the profit is a function of money, well, it may not increase. So EPS would decline automatically, right? So that is the consequence that you want to consider. And that's the reason why that statement, that profit is a function of money, becomes important here. Okay. And so is the case, by the way, with also a stock split, right? Now, what is a stock split to us? We say, if there is, for example, I have 1,000 shares of face value, right? Face value, let's put like this, at the rate 10 each. Okay, so let's say of face value at 10 each. It means that the total worth of the company is 10,000. Okay, but on the other hand, if I decide to split that stock, right, wherein I say that now each share is worth ₹5. Okay, so in a way, what I'm trying to say is that instead of 1 share of 10, you have 2 shares of 5 each. Okay, what is the consequence? We'll have now 2,000 shares, right, at 5 each. Of course, the value of the share is still 10,000. The value of the overall capital is still 10,000, but you have done a split of that share from 1 share to 2 shares. Okay. Again, it's purely an accounting entry, right? It does not give any money back to the business, which means what? Are the number of shares increasing? The answer is yes. Is there any money received? The answer is no. What is the obvious consequence? That the EPS will decline. Okay. So both in case of a bonus issue where you are issuing those out of existing reserves without receiving any money, or a stock split, we are issuing shares with a pro rata or a proportionate reduction in par value. Again, there's no money received. In both the cases, we treat as if these shares were always available with the company. Okay. Now, what does it mean? How do we interpret that? Let's try to understand this with the help of a small example here, right? It says that Venus Limited's issued share capital as on 31st of March 18 comprises of ordinary equity shares of 50 rupees each, which is for 20 crores, 10% cumulative preference shares of 2 each, which is 10 lakh rupees. And now it said that on 30th of September 18, right, Venus Limited issued bonus shares by way of capitalization of reserves in the proportion of 1:4 of existing number of ordinary equity shares, which means that for every 4 shares, there is 1 new share issued for free, of course, right? You're not charging any money from the shareholders. Now it's also provided profit for 2017-18 and 18-19 is 9 lakh rupees and 11 lakh rupees respectively. The question is, calculate the basic EPS for the 2 years, 17-18 and 18-19. Now what's happening? We have provided profit for the years, which is ending, 31st of March 18. Okay, so effectively we're saying 31st of March 18 and 31st of March 19. Okay, we are given the profit, which is 11 lakh here and 9 lakh here. Okay, number of shares. Okay, now before we go to the number of shares, it also given 10% cumulative preferences of 2 each, which is of 10 lakh rupees, which means that you are going to pay a dividend of 1 lakh rupees in each of these years. So the profit attributable is 10 lakh versus 8 lakh. Okay. So where I'm coming to, where I'm coming from is that if I just pick this figure straight away, that profit for the year, which is 31st of March 19 versus 31st of March 18, which is 11 lakh and 9 lakh, right? And then we are saying less preference dividend, which is 1 lakh in this case and 1 lakh in this case as well. This becomes 10 lakh and this becomes 8 lakh of rupees, right? Now, this is something which is the profit available to ordinary shareholders, right? Now, the question is, what are the number of shares, right? We are provided that each share is worth 50 rupee and there are 20 crore rupees worth of shares, which simply means we're talking about 20 crores divided by 50, that gives 40 lakh shares, right? So we can say this is 40 lakh in the last year, but there is a bonus issue of 1:4, which actually means that Now, against 40 lakh shares, now we'll have 50 lakh shares, right? So in reality, we would say this is 50 lakh shares. Okay. So what is the EPS now? If I were to just use that number, this is of course 8 lakh divided by 40. So 8 divided by 40, that gives us 0.2. And this is also 10 lakh. So this is divided by 50. That would again be 0.2. Well, this suggests that there's no change in the earnings per share. But hang on. You observe that the profit has increased from 8 lakh rupees to 10 lakh rupees, right? The profit certainly increased from 8 lakh rupees to 10 lakh rupees. Have you issued more shares? Well, yes, we did that under the bonus issue. Did you receive more money? The answer is no, because the shares were issued for free. Now, what does it mean? It means that the profit has increased without any additional capital coming in the business, right? The profit has increased without any extra money coming into the business, but the EPS is not reflecting that. The EPS is saying that, it's all the same. That's not correct. So what are we saying now? We are saying that if it were a case that the money has not come, but the shares have increased, but the number of shares have increased, we go retrospective and make this adjustment in the EP or in the number of shares itself. We assume that these 50 lakh shares or the bonus issue was always available, was always present, just for the sake of calculation of the EPS. My actual number of shares were still 40 lakh. There is no problem with that part. But from EPS calculations perspective, we will assume that this bonus issue was always in existence for each comparable period there. And that changes, of course, my EPS also, which is going to be 0.16 for the previous year. And of course, it is 0.20 for the current year. And now you are able to build that relationship. The profit increasing from 8 lakhs to 10 lakh. This is a 25% increase in the profit, right? Has more money come into the business? The answer is no. There's no extra money which came to the business. But this 25% growth is need to reflect that part. So we are saying that by going retrospective, we are able to showcase that the 0.16 has also grown by 25% to become 0.20. And that's the reason why for any such kind of instance, when there is a bonus issue or let's say a stock split, we go a retrospective, we do a retrospective adjustment or a change in the number of shares equivalent to arrive at that EPS in this kind of context. All right, let's have a look at the formal solution in this case. We have provided, of course, the profit for the year is 11 lakh and 9 lakh. You take adjustment for the preference dividend. The earnings available to the ordinary shareholders would be 10 lakhs and 8 lakhs respectively. But for the purposes of arriving at, let's say, the equivalent number of shares in each of these comparable period, we would go retrospective and say we had 50 lakh shares in issue practically forever, right? It was always there. And accordingly, your EPS is calculated at 0.20 for 18-19 and 0.16 for, of course, the previous year, 17-18. Okay. You don't have to do it 3 decimal points. You can always do it on 2 decimal points, unless there is a further relevant figure in place. Okay, right? Let's have a look at this example as well. This is a little more typical, but then we should be able to identify that or close that as well. Okay, we are provided following information pertains to Superpower Limited for the year ended 31st of March 2020. Okay, on 1st of April 19, the shares in issue are 1 lakh. Okay, on 30th of May 19, there's a fresh issue at fair value, right? You want to remember this date. How many shares? 20,000 shares. Now on 30th of November 19, there is a bonus issue of 1:3. Now, importantly, you want to remember at this stage, there are 1,20,000 shares. Okay. So on that bonus issue of 1:3, you will say there are additional 40,000 shares, which is basically 120 into 1/3, right? So that makes a total of 1,60,000 shares. And then you have another bonus issue, another further issue, sorry, at fair value, which is 25,000, which means your actual number of shares are 1,85,000. Doesn't really bother you, right? You always look at the weighted average number of shares outstanding, and that's what we want to calculate. Required to calculate the number of shares to be used for the calculation of the basic earnings per share. Okay, the dates are important, so you want to factor in that part. Let's use the space to do this. 1st of April 19, we had 1 lakh shares. 30th of May, which is 2 months later, by the way, right? Then we have 30th of November, which is 6 months later, which is 1:3. And then we have 29th of Feb, which is a month prior to the year end, right? Which is again at fair value of 25,000, right? Now, what is important to observe is that this is 1 lakh, which is fine. This is 20,000. So we get an extra issue of 40,000 as a bonus. Okay. What you want to also now take into consideration that the moment it's a bonus issue, you go retrospective, right? That's what we talked about. You go retrospective, and accordingly, we can say that whatever were the number of shares, right, they would need to be changed retrospectively. Whatever were the number of shares existing at a particular point in time, they change retrospectively. Okay, which actually means that if this is 1:3, okay, and that's where the calculation becomes 40,000 on 1,20,000, right? You want to remember that the number of shares which were actually outstanding here were 1 lakh and 1,20,000. That's what you want to remember. Okay, so the equivalent proportion, right, should be 1 lakh into 4/3 and 1,20,000 into 4/3 for arriving at that retrospective adjustment to those number of shares. Why 4/3? Because whatever is the number that you have got, you're getting 1/3 extra because of the bonus issue. This 1/3 is reflected through 1:3. Okay, so we are saying now 1 lakh into 4 divided by 3, that makes it 133,333, right? 1,33,333 becomes the number. Of course, 1,20,000 into 4/3 would make it 1,60,000. The bonus issue is any which ways around, and then you have got 1,85,000 as on this particular date, right? So these are the equivalent number of shares factoring, right, taking into consideration the bonus element also. Okay, now we can simply apply the number of months applicable. This is 12 months. This came in 2 months later, so this is 10 months, and this is only going to be 1 month in this particular calculation. Okay, and we can of course measure that number 133,333 into 12, 1,60,000 into 10, 1,85,000 into 1. Now this This is 16 lakh. This is also 16 lakh. And this is 1,85,000. So we're saying that this is 33,85,000 divided by 12. That would give 2,82,083. So these are the number of shares equivalent that you have. All right, or have we done the right calculation? Not really. So this is, okay, my bad. This is 133 for, sorry, this is 1,33,000 for 2 months, and then we have 1,60,000 for because we're taking the cumulative factor, so this becomes 1,60,000 for 9 months, and then 1,85,000 for 1 month. That's what you do basically. Sorry, my bad. So just quickly doing this into 2. This is 266,667, and then we have 160 into 9. That is 14,40,000, and then we have 1,85,000. We are saying that this total is 18,91,667 divided by 12. That gives me the equivalent number of shares, which is 157,639 approximately. We are saying that while the number of shares outstanding actually were 1,85,000, that 157,639 effectively. Okay, let's have a look at the formal solution. And that's what we got. The fresh issue, again, a fresh issue, and then a bonus element. So you need to kind of factor in those parts specifically. And then again, it's a fresh issue. So you bring those weighted average, and it is just a calculation that you could do, in different ways. So what we have done, the calculation would be on a, a cumulative basis on the number of months. The answer would be certainly not different in any of these circumstances. Okay. Right. Finally, what we want to discuss now is the right issue within the perspective of the basic EPS. There is another aspect which is rights issue. This is a little typical, so we want to spend a little more time discussing that in detail in terms of how does it really work for the calculation of the basic EPS. Now, what is the right issue, by the way? Okay. So think about like this. You are a running business and you want to raise more money from the shareholders, right? You want to go to the market. You don't want to pick up on the loans or let's say, borrowings from an organization, from a bank, for example. So you want to issue more shares to your existing shareholders, right? The argument is that, for the sake of, let's say, a number placing, we are saying that if there are 10 lakh shareholders, okay, and you want to, let's say, raise another 2 lakh shares, you want to kind of issue 2 lakh shares from the, or in the market, and let's say the market price per share is, let's say, 50 rupees. Okay. Now you want to raise money by issuing 2 lakh more shares. Now, certainly you can't go beyond 50 because nobody would want to buy your share at more than 50. Okay. The fact remains that you may not even be able to issue these shares at 50 rupees because effectively, if you're going to your existing shareholders, they could always buy these shares at 50 rupees from the independent market or the open market itself, right? So you really land up issuing shares at less than the market price, right? This could be 45 or 40 or whatever it is, right? But then the fact remains that there is not a full price that you expect to receive when you're going for an additional capital from the market. Your additional capital by issuing shares to existing shareholders on a pro rata basis. So when you have 10 lakh shares outstanding and issue shares, then you would go into 1:5, right? So you would tell every shareholder, and it's their option, by the way. It's up to them whether they want to buy it or not. Okay. So you want to go back to them and say that you have 100 shares. I want to issue you 20 more shares. Okay. So I want to issue you 20 more shares at a little less than the market price. Well, you may be interested because you know that, or you believe that the price will increase again. Okay. So that kind of a arrangement happens in case of a right offer or a right issue. Okay. So it is normally offered at a price which is less than the market price. That's what you want to remember. Of course, that means that you're not issuing the share at the full price. And certainly there is, of course, a free element involved, right? So if I say, for example, there were 10 lakh shares with a market price of rupees 50, and you are issuing 2 lakh shares, maybe at rupees 45. So it is not even 50 and it's not even 0. If it was 0, then it becomes bonus, right? So there's an element of free or bonus issue, right? And the moment you hear the word bonus issue or the free element, we do a retrospective adjustment to the number of shares. The moment you hear a bonus issue or a free element, what do? We do a retrospective adjustment to the number of shares, which actually means that post bonus issue or post the right offer, my bad on this, right? Post the right offer, I know my number of shares are 12 lakh, which is 10 plus 2, right? Pre-bonus issue or pre-right offer, my actual number of shares are 10 lakh. But for EPS purposes, they will be a little more than 10 lakh. What is that number? We'll do that calculation also, but it will not be 10 lakh for the calculation of EPS because there is a bonus element involved. There's a bonus element involved, and that results in a retrospective adjustment to the number of shares in this scenario. Okay. Now, that is what we want to do, that when there is a feature of bonus and of course, to some extent, a fair value, we need to assess what is that equivalent number of shares in that context. Okay. So we say that the company, of course, receives a consideration, which is available to obviously create more wealth, but at the same time there is also a bonus element, and accordingly you would need to kind of pick that up. Now, how do we assess, how do we bring that context is something which is discussed. We say you calculate first of all something called as a TERP, theoretical X rights price, or theoretical X rights fair value X rights fair value per share. Okay. Value per share. It's just post right offer. Okay. What are the total number of shares post the right offer, which is nothing else. What were the number of shares before the right offer, and what are the number of shares issued in the right offer? Okay. That's how you start looking at it. It's not complicated formula. It's just about understanding the context around it, right? We are saying the theoretical X rights price has to be measured, and now you use that theoretical X rights price to calculate that additional factor to measure equivalent number of shares prior to, very importantly, prior to right issue. This gives you the answer of what are those equivalent number of shares, right? We'll do that with the help of some numbers. Let's do some brief calculation here. We remembered we talked about 10 lakh shares and the market price per share is 50. And then we are saying that we issue 2 lakh more shares, let's say at rupees 45 each, right? In this scenario, my TERP, theoretical X rights price, will be number of shares outstanding prior to right offer into the market price, right? So this is before right issue, right? And this is the market price per share. So this is 500, and the number of shares under right issue and the price for that right issue, that would be 2 into 45. Okay. So this total amount is divided by what were the number of shares prior to right issue and what were the number of shares under the right offer. Okay, so this is where you look at 500 plus 90 divided by 12. That makes it 590 by 12. And that calculation comes at 590 by 12 is 49.17 lakh, right? 49.17, sorry, right? So we are saying that theoretically, right? This is the theoretical price. This is the theoretical price that you have for the share. What would be the actual price? Nobody knows. But fundamentally, conceptually, theoretically, this is the price that you're going to see, as a reaction in the market, right? So that's more of a financial markets context, but then let's not go further on that. What is important for us to understand is that post right issue, my number of shares are 12 lakh, which is 10 plus 2. Pre-right issue, my number of shares were 10 lakh. This is the actual number. But what we want to calculate is equivalent number of shares prior to right issue. Equivalent number of shares prior to right issue. And the way we calculate it is 10 lakh into the market price divided by that theoretical X rights price. Okay. And you would observe that the numerator is higher and denominator is smaller. So automatically the number of shares, the equivalent number of shares will be more than 10 lakh in this case, right? And that is how you are able to arrive at, the equivalent number of shares only for EPS calculation. Purely for EPS calculation, this is what is the number that you are supposed to use in real life. Okay, right? Let's have a look at this question, which says that Atom Limited's issued equity share capital. Atom Limited's issued equity share capital as on 31st of March 17, comprised of 9 lakh fully paid shares of 20 rupees each. The profits for the year ended 31st of March 17 and 18 were 3,15,000 and 4,37,500 respectively. Now, importantly, during the year on 30th of June, Atom Limited made a right offer of on a 144 basis at 60 rupees, and the market price just prior to right issue was 120 rupees. The calculation of basic EPS is required. Right now, this is a very tricky question, so please be focused on how do we want to address the requirement. Okay. I'm so sorry. We are given that number of shares outstanding prior to right issue. This is 9 lakh shares. Okay. Number of shares under right issue. With 1:4, we are saying 2.25 lakh, which is simply 9 divided by 4. Okay. That means that number of shares post right issue will be 11.25 lakh. So this is the number that we want to use after 30th of June. Okay. Before 30th of June, the actual number of shares are 9 lakh, but then they would be different for EPS calculation. They would be a little higher than, of course, 9 lakh in this case, right? Then we're saying, what is the fair value? We're saying 120. What is the right price or right offer price? Is made at 60, right? So we are saying that the equivalent value would be 9 into 120 plus 2.25 into 60, and that becomes 1080 plus 135, right? So that is basically a sum total of 1215 divided by the number of shares, 11.25. So 108 is basically the theoretical X rights price. Okay. What do you want to remember now? That the fair value or the market price is 120. Okay. The theoretical X rights price is 108, which means that the equivalent number of shares prior to right issue is 9 lakh into 120 divided by 108. That becomes 10 lakh. Okay. So what we need to remember now, and that's why I said it's a trickier question. My year end is 31st of March. Okay. My date of issue of shares is 30th of June. Okay. So importantly, when I look at the information on the profitability, for example, the 2 years, which is ending 31st of March 17 and 31st of March 18, we are saying 31st March 17 and 31st of March 18, right? We are provided the profit, which is 437500 and 3,15,000, right? Number of shares, right? Now this issue importantly was made on 30th of June 17, right? Which means that after 30th of June 17, my number of shares are 11.25 lakh. This is after, right? And before this date, the number of shares were 10 lakh. That's what we did the calculation as per this number. Okay. Now, if you look at this date, which is 30th of June 17, which falls in the year 2017-18. Okay. So effectively, we are saying that as far as the date up to 31st of March 17 is concerned, right? My number of shares are 10 lakh. So I can simply use the number of shares as 10 lakh for the entire period. Okay. But then as far as the year ended 31st of March 18 is concerned, we are saying it is 10 lakh, but for 3 months. And then it is 11.25 lakh, but for 9 months. Okay. So essentially my weighted average will be calculated in this proportion, right? And that's the tricky part as far as this entire question is concerned. So we are saying effectively our amount will be 11.25 into 9, which is 101.25. And then we have 30 lakhs, which is making a total of 131.25 divided by 12. That makes 10.9375. So we're saying 10.9375. And accordingly, the EPS will be calculated at 437,500 divided by 10.9375. That gives a EPS of 0.400 versus 3,15,000 divided by 10 lakh. That gives, of course, 0.315. Okay, so that is what you want to take into consideration when you're looking at the given information for the calculation of EPS under the right offer. What are the steps? Just to quickly recap. The first step is to calculate the theoretical exercise price. What is the theoretical exercise price? You look at what are the existing number of shares, multiply that with the fair value, plus what is the money that you're receiving by under the right offer. Divide that by the total number of shares which are there eventually after the right offer is complete. Okay, that gives you the theoretical exercise price, and use that theoretical exercise price to calculate the equivalent number of shares prior to the right offer. Use that as a factor, right? So that's where you start looking at it and get that answer there. Okay, don't forget to apply the weighted average for the number of months, because this right offer happened in the middle of the year or during the year, right? So that's also an important context, and that's a trickier part in this case. All right, let's have a look at the solution. We've calculated this 108 as a TERP, and of course we're looking at the bonus element, which becomes 10 by 9. So effectively the number of shares would be equivalent at 10 lakh in this case, and this becomes 10,93,750. And of course the respective earnings per share would be calculated for the 2 years effectively. All right, now obviously it's a recap. What we have done so far is for the EPS calculation, the basic EPS calculation, we make adjustments for the preference dividend and any impact of any cumulative or non-cumulative preference dividends, and even an early conversion of preference dividends to premium is impacted or is adjusted, versus the weighted average number of shares are picked up, impact of bonus, right, stock split, they're all considered with respect to the calculation of the denominator, which is the equivalent number of shares in this case. All right, thank you very much.